Hello everybody, thank you for taking the time to look at this video. I'm hoping to make it slightly more sophisticated as I intend to add some media that I obtained externally for the first time. It won't be dramatically slick because I am very much at the beginner stage in video editing. The purpose of the video is to add some commentary to the facts and figures that I posted on the website after listening to a very useful webinar presented by Stephen Bell, the Chief European Economist at Columbia Threadneedle. I want to really pick up on points he made about what we should be worrying about in our portfolio construction, and I should make it clear that he intends to do a New Year looking ahead video in January, so this is a staging post, as it were. His conclusions will appear in the aforementioned slide external media that will overlay my commentary before very long. So that's a bit of a spoiler. I'm actually not going to address the exact economic consequences, and you'll have to make your own mind up about whether you agree with what he says. But I'm going to talk more generally about what he thought on the most important topic for investors at the moment, which is Trump 2, Trump 2.0, the consequences of Donald Trump's pronouncements about his potential policy, his cabinet appointments, and the whole shenanigans that you will be reading about in your general media. The worst case scenario is that Trump's policies, the implementation of international tariffs, the retaliation by other countries, cutting of large numbers of public employees, elimination of regulatory agencies by the Department of Government Efficiency under Elon Musk, and similar consequences will be very serious. Certainly already serious for investments in environmental protection, sustainability and so on, where what was already a pretty backwards trend in the US is possibly going to almost return to base zero, which I think is very sad. It's possible that the global consequences will be so serious in the worst case scenario that we'll have another financial crisis like 2008 or even like 1929. And interestingly, there are quite a number of factors in play at the moment that resemble the situation in the third decade of the 20th century. So maybe we could have Great Depression Mark II. Taking things in more detail, looking at each asset class, I will start with fixed income because that's really the easiest. Fixed income or bonds, we're looking there at what happens to interest rates. As you well know, falling interest rates see capital profits in bonds as yields come down. Yields had been coming down, but the American Central Bank Governor Powell has said he's going to be more hawkish, and apparently other members of the committee, the Fed committee, have said the same. We don't know, as I make this video, what's going to happen next, but it's quite likely that inflation will hold on for longer, maybe pick up, in which case central banks will stop cutting interest rates in the US, and that will be bad for bonds. Corporate bonds are also trading at very little premium to government bonds. You're not getting paid much for taking the risk, so there's really little capital profit to be had. We will have already had some capital profit in the last 12 months or so, 18 months perhaps, but perhaps that will go flat. Gold is a very interesting asset class in this situation, partly because Trump's policies are clearly going to irritate all sorts of other countries, and the emerging market countries that comprise the BRICS, which was the original ones whose initials make up the name, Brazil, Russia, India, China and South Africa, have expanded, I think, to 9 members now. They are really seriously talking about trying to operate a currency to compete with the dollar as the global reserve. And of course, Trump has already commented that if they do that, he'll punish them. He doesn't want that. It's fundamentally the most important thing to the US economy that the dollar is the global reserve economy, because if it was not, people will be questioning the huge debt to GDP ratios in the US. and wanting a bigger premium for lending to the Americans, and that would mean US debt costs would increase significantly, and US borrowing ability would potentially reduce. And bearing in mind that they live on their debt, that would be a disaster. So, going back to gold, countries wishing to build a reserve currency, whether it's physical or digital, probably have to back it up with some reserves. And classically, the reserves in central banks, the backup currencies, are gold. Furthermore, gold is an asset that can be traded irrespective of what's happening in global sanctions. Nobody seems to have been able to sanction gold, as I'm sure a certain Syrian leader is contemplating at the moment with some satisfaction. Commercial property, interesting asset class, but not going to be as defensive as it typically would be, partly because of the major structural issues. We know that since the pandemic, there's been significant alteration in the way people go to work, where they appear in offices. Maybe that's reversing, but the trends in shopping are not reversing. People will buy online. There's less demand for small retail shops, and I think that much more demand for logistics warehouses. They're being put up in scale where I live, and the infrastructure that goes with them. There's demand, no doubt, for electricity supply, transport, and so on. But commercial property funds are the slowest of fund managers to move, because it's just not feasible to dispose of property assets by clicking a mouse button and waiting for a contract note. Liquidity is always a negative on commercial property, and at the moment I think it's such a negative that only the very brave would invest there. Cash as an asset class is very attractive at the moment, partly because it's defensive, has little volatility. Interest rates are still, in many economies, a little bit ahead of inflation, and that is a nice way of maintaining the value of your cash whilst having the opportunity to purchase good assets if there is a major crash when the mopping up gets done. Equities I have left to last because that's the most complicated. Which equities is a big question. I think some equities will prove to be Trump proof, because for every negative consequence of Trump tariffs, there's going to be a positive consequence for somebody else who can fill a supply gap or supply at a lower price because they're not tariffed. An interesting example of that might be Taiwan. A Chinese difficulty in supplying, for example, clothes due to very heavy tariffs might equally be an opportunity for a Taiwanese or other Asian economy that has a clothes manufacturing facility, Bangladesh for example, maybe even Turkey, to supply more into the US. So, do I have any ideas about equities? Yes, I do. I think at this stage I would float for your attention the possibility of investing in India. I've already written a blog post about that. India is a growing economy anyway and looks unlikely to be impacted by sanctions at present. Japan is very important to the Americans, and the Americans are relatively friendly with Japan because, after all, their Pacific defense is highly dependent on the bases they have in Japan and the associated islands and peninsulas. And so one would think the Japanese are not too worried about Trump. Investing in Japan is difficult because classically when the economy does well, the currency's doing badly. I've never managed to make much money in Japan, and I think you've got to be very careful picking a Japanese fund manager. It's got to be somebody who speaks Japanese, has lived in Japan, understands the culture, the different way corporations operate, the level of political corruption, which is higher than in many developed economies, as far as I can tell, and so on. Then there are specific themes, not just geographical selections. Investing in military equipment production and everything that goes with that is almost a guaranteed win. Sad though it makes me to say that. A Republican administration in America is never going to be bad for the defense industries, and with the number of wars going on that are consuming billions and billions of dollars of equipment at the moment, clearly there are going to be gaps to fill in the inventories of many countries, and there is a Keynesian economic effect there, which is highly beneficial for certain industries, certain companies, and indeed some countries where those companies will base their manufacturing operations. So that's my teaser for what we ought to be looking at in 2025. Thanks for listening, and I will close by wishing you again a wonderful holiday season, happy Christmas, and a great start to the new year. I'm not saying it will be prosperous, but it will be interesting. Bye for now.